So then, James, tell me a little bit about growth notes. I know that's another form of structured notes that you all use there. So talk to me a little bit about those.
You bet. So unlike income, which again, income pays you a stream of income over each and every year and then your money back at the end, a growth note is very similar on the downside protection piece, where you have a contingent protection, 30 or 40% protection, and you get all your money back in case those indexes are down. The difference is on the upside. So what clients are giving up in growth is any return, money back, dividends, interest each and every year. They get a pop at the end. And so we'll use an example of a 5-year growth note tied to the United States stock market. I'll blanket it there. You take the United States stock market return. Again, you're not getting any payments for the whole period of 5 years. So you have to stay patient. We have to teach our clients, stay patient on this. However, at the end, you receive a leverage factor, a multiplier of that return of the United States stock market. So we might use the S&P and the Russell and the Dow. And what happens is they're correlated. So you take the worst performer of those three, which in reality, one might be up a total over that 5 years of 40%, one might be up 32, and one might be up 28. So you take the worst of those three, if that's the case, and you take that 28%, and it's often 1.5 times that, for example. So 28% times 1.5, what is that? 42% return. That is your return over that 5-year period of time by staying patient. Giving those examples, this is where people bet on the future for growth. When you combine income for stability and returns with growth of, hey, if the market does really well for 5 years, I can double my money. When typically I double my money every 10 years, the 7% rate of return. And so our job as advisors is to mix and match what makes sense given a client's situation. And the last I'll share on both of these notes is, you want to spread out the years for, time risk. You want to spread out the banks for concentration risk with banks. You want to make sure it's in an asset location, tax efficient strategy, And so all these tie together within the holistic approach, but that's all alternative investments for those clients that it makes sense for.